So our requirements to Bento will be, first of all, distinguish between a management buyout and management buying, and discuss the relative benefits and drawbacks to Okazuko if it is disposed through a buyout as compared to a buying. So we can start A. All right, so I need you. How do we go about this now? So they say distinguish, so I can define both of them. In a management buyout, the existing, the management, current management of a firm take over the ownership of that firm from their shareholders. The mark allocation is small. On the other hand, a management buying how did I say buyout before? I'm using it as one word. So buy-in involves the takeover of a firm by managers of another entity. Now, both strategies are usually financed using significant leverage. And I've not done any distinction. Now, for Okazuko, what did they ask us for? So that we're answering the question directly. I have to go back. Constantly make sure you're not doing what you want to do. So relative benefits and drawbacks to Okazuko if it is disposed. And for Okazuko, if it is disposed through an MBO, the management would have. Okay, I was expecting this to be a conversation rather than me just typing, because we've done this before. So what's the benefit now? Just one word, or a few words, and what are the drawbacks so that we can get this over with? Yeah?
Having corporate indigestion.
I like the way you say that one first. But what's the first thing? Corporate indigestion, okay, so they will be able to protect against, so it's not likely that there will be corporate indigestion because they're already in exist. They're already there. So,
yes.
But the first thing I'll think of will be things like experience.
Yeah. The existing management, they already have knowledge of that business. So
yeah. So experience and knowledge I don't know whether they're not the same thing, of the operations, and so would not require much time to implement the necessary, that's not the spelling of necessary, strategy for the firm's progress. So that's one. Then also the current management would also, it is likely that staff would not, I don't know that the word is resent as much as would not, that, how do I say this thing now? That there will be less friction with staff.
Yeah, less resistance and
That there would be less resistance by existing staff to the new ownership due to existing relationships, and also or and issues of corporate. So let me put your word, corporate indigestion would be minimized. Now, on the other hand, it is likely that previous weaknesses might continue to exist if an MBO with MB manage to continue to the company forward, which would not happen with an MBO. Okay, so that's more than enough writing for 5 marks. They've given me 5 marks. That's what I was conscious of. So I take 1 mark for both definitions and then 1 mark for 3 relevant points. I think I gave 4. So 1, 2, 3. Oh, I can look at that as 3. So 3 points really. And that's our 5 points. Be careful about overwriting. Be very careful. Most of these my points were quite long. However, it's hard to have shortened them, to have summarized them further without missing the plot. But is this clear? The main benefit of an MBI will be experience new ideas, fresh blood, and that fresh blood can kind of rejig particularly ailing companies with ideas that have already been saturated. On the other hand, the experience of current operations by existing managers will be a major benefit of an MBI, of an MBO over an MBI. Is that clear? Are we good with this?
Yes.
All right. So let's go to the B part now. So B, this one has its own issues. I think the first thing that piqued my interest is the first part. So what did they ask us for? Whether the restrictive covenant will be met.
Yeah.
All right, so let me just title my work. So that would have been a management buyout versus a management buy, and then issues pertaining to that restrictive covenant now. This Excel, they should start underlining things that are written wrongly. Covenant.
Ryan,
Yes, please.
so your third option, your third point, is that a benefit or a drawback?
A drawback. On the other hand,
Can you read it?
on the other hand, it is likely that previous weaknesses. So on the other hand, it is likely that previous weaknesses might continue to exist. Full stop. With an MBI, the new management could bring in new ideas to take the company forward, which will be unlikely to happen in an MBO. That's a weakness for the MBO now.
Okay.
Do you get that?
Yeah.
And immediately I said on the other hand, I said also is a complement to whatever was on top of it. On the other hand is the exact, I'm saying on the other side now. So that's a weakness. If you wanted to write advantages and disadvantages, that would be fine. I find it very unprofessional to write things with too much. I like a logical flow. The only thing is, if I put that in the same paragraph as something else I'm saying, then you will not expect the marker to see that. And you will confuse someone or stress someone that is marking it. However, if they are separate paragraphs, then I can see a logical flow. And if you can use, I don't know whether the word is adjective. My English is not that good. But if you can, it's not good at all. Sorry, let me rephrase that. If you can use paragraphs to get your points, then I can follow through and use, like I said, whatever that thing is. So if I say, and also, because added to that as a follow-up, all those kind of things are additions. But if I say, in contrast, on the other hand, as opposed to that, all those things will now be the other side of the argument. All right, so is that fine?
Yeah.
All right, so the restrictive covenant now. I think we'll start with our 30 million bond. So the $30 million bond is structured as an amortized payment now to get the annual payments, the annual payments, in bracket, the annuities, we compute or we divide the total bond by total bond value. But see, we're hearing you by the total, and please don't make us hungry while we're at it. So you've committed 2 offenses in one Gary sentence. Well done. So we divide the total bond value by the annuity factor. So,
Mr. Byron, I've seen an APV question like this.
APV?
Yes.
Yes, possible. It's possible. This can be in anywhere. It can be every, you know that one of the fundamentals of financial management is time value of money. That's why we would abuse things like ARR, that's accounting rate of return, would abuse payback, would actually even ignore them for the better part, because those things don't, our core concept is with time value of money. It's very, very rare for you to see anything that we're not considering. And if a question wants to tell you to ignore time value of money, to be very explicit about it. So yes, it will be very, very pervading. The only thing is I can't remember doing anything like this in any question prior to now. It's something I'm happy to see.
Not the one we did in class.
Okay, so that's cool. So, okay.
The
all right.
The AP, yeah, I've seen it too.
All right. So it's good that we're doing this again as a revision. So to get the annual payment, that's the annuities, we divide the total bond value by, by the annuity factor, right?
Yeah, annuity factor.
So our annuity factor, I've not, William, are you here?
I'm here now. I'm going to say annuity factor.
Okay, I didn't see you. I don't know. I don't know whether it's only yesterday. But I didn't see you yesterday, Abby.
Oh, I was there yesterday.
You see, this hiding face is causing us a lot of problems. All right, so our annuity factor at 8% for 4 years, Abby. It's 4 years, right? Yeah, for 4 years. So annuity factor at 8% for 4 years.
3.312.
Thank you very much. So I don't need to do that calculation because I really hate doing that thing. So it's equal to, you said
3.312.
312. Okay. All right. So therefore, I wanted to say the annual annuity. So therefore, the annual payment, or what I would have just called the annuity, will be equal to How much is it? 30 million, right?
Yeah. 30,000.
So what do I work with now? Should I work with millions?
Yeah, 30,000 millions.
So I'll work with millions now, and I'll just, so everything will be point something. So it'll be equal to, I should have written out first. So it's equal to 30 divided by that figure. All right, so that's what we'll pay every year. I carry it down. Come on, it's disappeared. Control F, Control V. All right, so that's our figure. I will just clean that up a little. Too long for my liking. I'm going to use all of that. All right, so that's that. So that's our annual payment. Let me see how many. Okay, I trust Excel to carry it like that now. What's that? Oh, sorry. Okay, 0, so that's fine. The rounding will be very small. All right, so that's our annual payment. So if you see, if we pay 9 million every year, it was a 30 million bond times 4. That's 36. That's over 36 million. So the interest is already embedded there. So then we can do our the flow of the cash flows for that bond. So we'll use that if I reason rightly. So we'll use that for other things. So the cash flows over the life of the bond. I don't know how to say that. Remember, there are a number of things we are working with. So we start, so is that year? Okay. So year. Then we have opening, right? Then we have our interest is on the opening. So interest, then the annuity, our payment, so payment, and then we'll have our closing. Okay, that's fine. I think that pays us more. So year 1. Two, 3, 4. So our opening 30 million, Abi.
Yeah.
Our annuity, I don't know whether this thing will work. Okay, let me just put it first. So 30 opening, our interest now. So our interest is at 8%, Abi.
Yeah.
So at
2.4.
8% of opening, so that we just get that. Is Halima here?
Yeah.
Oh, okay. Just remember that. How's your health now?
Much better.
Okay. Did we see yesterday at all? Were you here yesterday?
Thank you.
Were you here yesterday?
Yes, I was.
Oh, okay, sorry, I didn't ask you. Okay.
Thank you.
All right. This thing, I just extended this thing beyond my liking. So maybe I'll shorten it later. So our interest is 8%. Okay, maybe in the future, I'll do that thing before I come to class so that I'll be able to do it in class. I'll just do an amortization schedule. That'll be very interesting, especially when computer-based starts. So you just do this thing at once. All right, so 2.4. Then our payment is the same every year. So hopefully if that thing works out, not mind. Okay, so what I would have needed first of all, for that figure, I want to all right, so that's that. So I'll carry you downstairs. So for the 4 years, I have that figure. And then my closing now. So the payment, let me go back, it's supposed to be negative because that's what we're paying to reduce that. I hope it affects all of them. It didn't. So I'll have to come and drag you again. All right. Then our closing now, our closing will be equal to this plus this minus that. That's equal to the sum of the three of them. That it should be reducing every year, right? So this one will now be equal to, we're paying more than the interest here because we're getting that to 0. So hopefully without rounding, we should get 0 in the final year. So that will be equal to 8%. I put the 8% somewhere that I could have been packing it. 8% of the opening, right? Lillian, this is similar to what you've done before, right?
Yes.
All right. Okay, so let me clean this up.
Why are we not deducting the 2.4?
Not, no.
2.4 is interest, is adding to it.
Yeah, so why are we not deducting it? Is it because the payment already includes interest?
We're adding the interest is paid, so it's increasing the liability, and then the payment is now reducing. It's the payment that is subtracted, not the interest. Do you get what I'm saying?
Yes, so I'm saying this annual payment we are paying now, is the interest embedded in it?
Yes, that's why it's an annuity. Is the interest, that's the whole idea why it's an annuity, because the interest is factored into it. We factored all the interest that will be paid into, that's how you get an annuity. That's why at the end of the period, you're expecting that you have 0.
Okay.
All right, so this one should be, give me, okay, so that will be easy for me to do. And then this one will be equal to that one. And then that one will now be equal to, I don't know, since I have 2 of them, if I drag that in, it should give me this one now. I want to be as lazy as possible. Then this one, I don't know whether this one will work. So I'm just typing figures here, and then this one should be equal to that one. And then the rest of it, I should be able to do lazily. So as lazy as possible. So this one now should be equal to, so if I have those 3 and I drag it, it's not working. What did I now do wrong? Okay. Laziest of them all. So no, I shouldn't have done the equal to. And drag it for this one. Right. I'll check it here now. It's right. So it's equal to. Okay, so that one will be. All I need to do is drag that one down. Yeah, 0. So that's essentially 0. The 0.002 is just rounding. That's negligible. Fine, Abby?
Yeah.
All right. So at least we have our closing bond value. So now we can now start our work. So that's one thing.
There's another loan.
Yes. So we would have those loans, but for us to do our equity will not just be that we would have retained earnings. So how do we do this now? Are we going to calculate the retained earnings first? We'll have to calculate the retained earnings, right? Do we have retained earnings in the Just give us equity. So earnings, we'll have to calculate the earnings. You get what I'm saying? To add to equity.
Yes.
All right, so
I think,
earnings. Yeah?
and they say it grow by, that is, we have to pick the operating profit, is it?
Yes, for 4 years.
For 4 years, okay.
So we'll do earnings for 4 years. And then we have, how do we do this thing? I'd have prepared it up. Why did I do this thing like this? Which one is easier for me now? Up or down? We do it like this now. So our earnings for 4 years, our profit before tax, profit before interest and tax, PBIT.
Yes.
So we'll do that times, it says 11%. What did they say it will grow by? 11?
11%.
So it grows by 11%. And dividends, so we'll subtract dividends from that. So 11%. No, we would have done year now. Where am I? So where's the year now? Okay, so the years will be on top. Okay, that's fine. So copy.
Madam Lillian. Madam Lillian.
Yes.
That APB question is 2018 December, Abi?
Yes.
People that are angry. Is it the same exam all of us will write? Hey, God will help us. Oh, God will help us. I'm surprised that nobody said anything. Is that just fear manifesting itself in different ways, or confidence that don't worry, nothing will happen? Nobody's still answering. Nobody's finding this thing funny. I trust you. I knew that if the thing is worrying me like that, and I talk, I will be corrected. Thank you, ma. Okay, when some people are... Yes? You said what?
Worrying you. I said, what's worrying you?
When I start misbehaving now, I know that they will correct me sharp. So I don't have problem. I'm just praying that some people are hearing that some people have done up to 2018. You know, they started from 2005. They have gotten to 2018 past question.
No, it's not like that.
It's remaining only 2019 and their revision are finished. You're saying I've not started reading.
They'll finish next week.
You're still saying I've not started reading. Every time you say God, God, God. We'll see how God will do this one now. Don't worry. Time is coming. We'll see whether God will put his hand inside.
God now. So just face your work, face your own work.
Yes, ma. I know. All right, ma. No problem. All right, so our profit before interest and tax at 11% growth. So they said this is growing by 11%. So we start with the first year. So our first year will be what we have in the current year now, this question zone, which is something that we've seen before. So we're practicing things that we know and love. So operating profit, Abi? Could have called that operating profit so that we'll know what we're saying. Is this clear to everybody?
Yes.
So I would have liked to call that operating profit somewhere. So it will be equal to, what's the operating profit in the question?
12,200.
12,200. So 12,200 multiplied by, okay, so I'll do that with my table so that it will carry it and go. So 1.11 raised to the power. So I'll just put that raised to the power of 1.
The power is 2 times.
Yeah, I know, it's the way the thing is to misbehave. So raised to the power of 1. So I get that figure, and then I can drag it for those 4 years.
Yeah.
All right. So All right. Then, why this figure is higher? Okay, so what's the next thing? Tax, Abi? So our interest now, our interest is what? Remember, we're paying interest on the second bond. 2. So is that 2 interest? Nobody answer me. What did I do wrong?
Yes. We'll just have debt 1, debt 2, or something like that.
And so we'll have 2 interest, Abi?
Yeah.
We already have the interest that we've calculated now.
Yes.
So we'll just have interest 1 and interest. The other interest is straightforward now. That one is constant, Abi?
Yeah.
All right. And those will be negative figures now. So the interest on the first bond is how much? Is
0.4.
is that what?
Okay. 6% of 20 million.
So 6% on 20 million, and that is every year, right? So we can just take that directly. And then is the second one that is our headache now. Should we have done that separately?
No, you have it there already now. The interest for...
No, for the first one. So we'll do interest on, maybe that would be the easy, interest on, what do we call it now? What's the name of that bond?
Convertible bond.
No, not the, okay, yeah, so we'll do the interest on the
convertible.
8% and 6%. So that will be easy for us now. On the 8% bond, the 8% bond is the one we've already done.
And 6% times 20.
So for the first year, it's equal to minus, where's interest? This interest, Abi? Interest, yes. And then for the second year is equal to minus that figure. Then in the third year is equal to minus that figure. And then in the fourth year is equal to minus that figure. Then so interest on the 6% bond so we can come and do that as a working somewhere. So I can come and put my work in separately. Interest on 6% bond. What's that? 6% of what?
20.
So 6% multiplied by 20.
It's 1.2.
Yeah. So 1.2. So we can come and put. So it's equal to minus. It should not just work. Okay, so unless we'll just do that absolutely. Okay, so here I'll absolutely so that I can carry it. I'm ready to do this one. So dollar, so that I can carry it. All right. So 1.2, and we can have 1.2 for all the years. It's not going to change now, Abi. So after that we can get our profits after profit before tax so that we can charge tax on it. So PBT will now be equal to the sum of those ones. And then we can drag it for all of them. And then our tax now, tax is at what rate? Tax is at what? So what happened now? It's at the end now. I remember saying tax.
25%. 25.
20. Oh. Is there 25?
20.
Sorry, 20%.
20%.
So at 20%. All right. So in the same year, Abi, is equal to minus 20%. I hope this works. Multiplied by the one on top. Okay. So I think that will work for all of them. The only thing is I need to play this. All right. All right. So our Patricia now will be equal to this one minus or plus now because I've made it negative. Be careful about these things. So, oh, okay, there's no need except the writing the computer. All right, so that's that. And then I will have our dividends now. They say dividends are what? Can't forget that dividends. That's why they give us there. So dividends are at what?
25%.
At 25%.
25%.
So at 25% of part. And I have no problem with doing that. I hope this thing doesn't go out of scale. All right, so that is so equal to 25% multiplied by the figure on top. I also want that to be negative. Let me do that quickly. That goes there, and that's so our PAM now. So our PAM or retained, let me call that retained profit. Retained profit. That's not PAM, God forbid. How did you say that? So it's equal to this plus again that. So can drag. And then we're done. So we have that figure. So with that, that has set me up nicely for my gearing now. Or how do I call that now? So I can call debt to
Brian,
yes. What did they say they use for their
please, your
debt? You said?
your computation again. Sorry.
Okay, I thought you
You know
said
when we did
you're
this,
complicating this thing. Sorry. So yes, I can
sorry?
hear you. No,
I said your
no.
computation, your computation.
Yes. What did you say?
Okay. I said when you computed, when we computed that interest and annual payments, but we're working in millions, right?
When we computed, I didn't get. When we computed what?
Those cash flows now, the payments, the annual payments, that
Yes.
table we did just now.
Yes.
Up. Yes.
Yes.
You were computing in millions.
Oh, that's true.
Yeah. So now bringing back this year, you now brought the point. It's supposed to be 2,400 and 1,200.
Shit. Thank you. God.
Because they're now doing in thousands.
Are you serious? I'm telling you.
That's why you're asking why is it so high?
Are you serious? I didn't even notice. Thank you very much. Okay, so I think I can easily correct that now. Wow. Okay, so the only way to correct this is now to increase these ones, Abi, because those ones have.
Yeah, so you'll be
Scatter
putting
this thing.
2,400,
Yes, I get.
1,008.
So I have to correct everything. There's no way to just get everything and just multiply. Allow. Are you serious? I didn't see that. Thank you. I like working with millions. I hate this thousand. I have to do all of them one by one. Okay, so I'll 1,000 it up.
Multiply by 1,000. Yeah.
That's what I'm doing. I don't know whether it will work for all of them or it will just give me 0. It didn't work.
It will work. Oh, no.
It didn't work.
Sorry.
It didn't work.
No, copy. You can copy it exactly the way it is.
So maybe I can make
Then remove the dot.
1,000 absolute. But where did I get the
Absolute
figures
figures.
from? I didn't. I got them separately, so it will not work. I just have to do them one by.
Yes. So these two.
I didn't. They're not the same thing now. I got them from different places. So 2004. This one 2 times 1,000 again.
2004. 1867.
Yeah. Thank you. Thank you for that information. Okay. 2 times 1,000 again. That was careless. Okay. Yeah. Times 1,000. All right. So that's that. And then the same thing on the interest again. Okay, since this one is the same,
yeah,
I can multiply that by 1,000 and drag it. All right, so that's that. Thank you. Okay, so I think it will correct every other thing now, so we don't have any problem. So we have our retained profits there. Okay, so debt to total capital now is the next thing. All right, so our debt 1 is debt to total capital, they told us, Abi? Nobody answered.
Yes.
So the first bond was 8%, Abi? The first bond is the 30 million, 8% bond. So we're still using the same years. So I'll take that for granted. So we already have that figure. So the closing, we're looking at the closing values. So we're just going to pick all of them. So, right? Like we're looking for it at the end now. Yeah. It's at the end of the year now. Is that not what they said? Is it at the end of the year or the beginning? Please let me not be careless and then come back and find out that I've made a mistake. Is it at the end of the year or at the beginning of the year they said?
Beginning.
Is it beginning? Shit. Oh, God. Am I just being careless? Let me read the question again. This is just carelessness. Okay, so they said, okay, so they said, as a condition for providing finance, DOFOCO will impose a restrictive covenant that the new company's gearing ratio will not be higher than at the end of the first year, at the end of the first year of operations. So end. All right. So it's equal to this figure. And that one's 0. I'll take it as 0. It's rounding error, so 0. I'm not putting anything for that one. Then debt 2, or bond 2. Where did I call that bond? Bond 2 was the, how much? 20 million, 6% bond. Ife, how much is that? 20, Abi? Oh, okay. We started this thing again. Let's not go and backfire. Am I converting it here? It has gone again. All right, so I'll just take everything as thousands from here. Okay. Yeah. I don't like working with thousands. But I know how to protect. Let me protect myself now that I thought about it. All right. So bond 2 is now, bond 2 was 20,000, Abi?
I don't understand where you got these figures from.
These are the bond values now, the closing bond values that we calculated here.
Okay.
That's the bond value now. That's what we're looking for, the value of the bonds. So that's why I wanted to check whether I was closing or opening, because that will guide my thoughts. Do you get?
Okay.
All right.
Yes.
Now the bond 2, that bond 2 is not going to change now. They say it was 20 million, right? So 20 million. So we'll just use 20,000 for that. So 20, 1, 2, 3. And it will be the same figure every year. I don't think this works. Doesn't work, right? It does work. That's cool. Okay, so so we have the total bond. Then we'll do our equity now. So equity. And do your total bond. Man, that's what I was looking like it has almost ended. It's quite disappointing. So total bond is equal to, yes, please, some.
Where did you get this 20,000 from?
The 20,000 for bond 2 now. It's not 20 million bond. That's what I've written. That's all. If you get to that, it's 20,000. It's 20 million bond. I'm working in thousands.
I get you.
Yeah,
I get you.
Oh. All right.
Yeah.
Okay. All right. So our equity now, is IFI back. Equity. So
Yes.
we're looking for you again for the second time. I told you anytime you go, even though you've been going plenty times, we've not been catching you, but we'll be catching you small. So our equity is 5 million from VC and 5 million from management, Abi. Oh, that's ordinary shares first. That's not really equity. Oh, maybe we should have written that somewhere so that this thing doesn't become messy. So ordinary shares. And then we can write that close to it, that the total book value of equity will be equal to the ordinary shares plus the retained profits. The cumulative retained, but that's what retained means now. Retained profit or retained earnings. Let me call that earnings because it will accumulate over time. What else? But there was something to note before that. The ordinary shares would be a combination of the 5% the 5 million from, who's that now? Venture capitalist, Abi? And 5 million from the senior management. That's what it's called. All right. So ordinary shares will be 10 million. So 10, 1, 2, 3. So that's it for every year. And then our retained earnings. So I think the retained earnings will give us small work now. So it's equal to that one in the first year. Okay, sorry, this one in the first year. Then in the second year, it will be equal to, now it will take 2 of them now, right? So it will be this, except we wanted to accumulate them on top so that you understand how we got what we got. Well, I think that it will be easy for you to follow this. Is anybody here at all? Lillian, are you
Yes.
here? All right. So it's equal to the 3 of them. Okay, there's no need now. It will just be this now plus, I'm just jumping up and down. I should have one structure so that it doesn't confuse people. So this one, I'll rather call it, how did I do that? It's equal to that instead of doing that other one. Let me do it. Let me redo it. First problem. So it's equal to the figure for this year plus the one for last year, which is the same thing. It's still giving the same value. How can these people move back? I hope I've not done anything wrong here. So it's equal to this figure plus last year's one. All right. So hopefully that is the correct thing. Okay. Retained profit is retained now, so it will still be there. Yeah. So this one was this one. This one is that 43. Yeah, plus this. 53, 43, plus. Yeah, that's fine. Yeah, absolutely. So our total equity now, so total book value of equity will now be the summation of that is equal to this. Is Lillian back?
I didn't go anywhere.
I thought I called you before. Was it not you I called?
And somebody answered.
You said what?
I heard.
You just didn't answer.
No, somebody answered now. You are looking for somebody to answer.
Oh no, I wasn't looking for. So that's why they don't used to answer me, because they think I'm looking for someone. No, how come these things are black like this? What's this color that came now? Hey, God, I don't like it. What's this?
Excuse me, please. Can you put the way you got this 10 million for people? As in, if I would want to read later, I would not know what's up with this 10 million.
I wrote it down. Say it here now. I say ordinary shares will be a combination of 5 million from venture capital and 5 million from senior management. Okay, so I don't know where this color came from. I don't know what I have to press. Okay. Where's that now? That 10 million. So ordinary shares, note 1. Let me come and call this note. Is that fine? Maybe.
Yeah, it's fine.
Fine? All right. So is equal to 10 million. I'm not enjoying this color. That no, okay. So we can do our total capital now, right? So total capital is equal to equity plus debt. All right. I take your back, sir, which is good for my health. So it's equal to what's this figure plus what they want someone to be doing. Does this thing even-
Brian,
Yes,
sorry, I'm lost.
yes, please go ahead.
I'm lost. From that dividend you computed, sorry, my network logged me out.
Yes, I noticed
Thinking
that you
that-
just came back.
Yes. From that, where did you get your dividend? 25%.
25%. My dividend
I'm looking for it in the question.
is there. Is them that called it for me. I hope they didn't call wrong thing. Because if they did, okay, but
Annual
everything.
dividend of 25% on available earnings. Okay.
Yes,
In
yes,
the next 4 years.
yes, yes. That's that place. Yeah, that's it. Right?
Okay.
Yeah.
Okay. Then, okay, what you're doing now, you're doing this debt to total capital.
Yes,
You're joining all the bonds together and you're
yes,
combining with equity, right?
yes. And I'm also looking out for equity so that I can get my total capital. Once I've gotten my total capital now, then I can find the debt to equity ratio so that I will know whether they have exceeded, whether they've exceeded what the venture capital is set for them. Because that's what the
Okay.
requirement said now. We have answered that
Okay.
question now for those 12 marks. So they said whether the restrictive covenant will be imposed by DOFUCO is likely to be met.
Okay. But in that computation we did, this 20 million loan, it has nothing, there's no computation. This conversion has nothing to do with the question,
Most
right?
of the time, a convertible bond will have nothing to do with the question. And because the question now told us that it is that our debt to equity is book value, not market value. So that's why it makes there's not doing anything for us, right? I think they told us that now.
Okay.
They told us
Yes, it's book value. So
that's book value. So there's
they
nothing
told
to
us it's
do
book
with the
value.
convertible bond. Yes. So that's the book value we're going to use.
So if it were to be market value,
Then we'll find the market
in
value of
another
the
case.
convertible bond. Yes. So we'll do that thing we normally do now, interest and repayment, then cost of debt, and then multiply the interest and repayment by the cost of debt, annuity and present value for the interest
Okay.
and then the repayment.
Okay, thank you.
That's what I would have expected.
Brian, please, I was logged out. How did you get your retained earnings?
Retained earnings is accumulated profit, like what we normally do now. So last year's retained profit plus this year's retained profit will give us the next year's one, and so on and so forth. So for the first 3 years, so I wanted to do cumulative profits. If I did cumulative profits, then that would have shown us where we got those figures from. So since I didn't do it, I just didn't suffer. I just did. So you get what I'm saying, Abi? Year 2 will be year 1 plus year 2 retained profit. Year 3 will be year 1, year 2, and year 3, and then year 4 will be 1, 2, 3, 4.
Okay.
Yeah. Okay. So debt to total capital. We've gotten total capital. So the next thing we can do is our debt to total capital ratio as a percentage, so that we are done. No, this thing doesn't look. Okay, sir, are you back? This is our fasting rules that we don't obey again. Is Mr. Yaya back? No, it's not. Okay. So debt to total capital. Is debt to total capital now? Is there anything to ask again? So debt to total capital will now be equal to the bond. Remember, it's not the equity, and I can multiply that by 100. But that 100 has to be absolutely. Oh, so they met it this year. I'm happy for them. Are you sure? Please, those people that are using other things, please. I just want it. They said I want it in that. Oh no. Let me make it easy for me. Okay. All right. Beautiful. All right. So let's start arguing now. Yes or no? So let's ask ourselves that question. Beautiful question to answer the question. Is the restrictive covenant met?
Yes. For year one.
I thought they said not higher than 70%.
Yes, it should not be higher. So in year one, it's not higher now. It's less than.
7,
It's less than 70%.
75.
It's less than 75. 75, not 70.
Mm-hmm.
Okay, sorry.
Okay.
But in year 2, it was over.
We'll see. We'll see. I'll just be looking at all of them. So, yes, Abi. So, yes, yeah.
Yes.
Year 2, they said what? Hey, God, I'm going to shift this thing down. Oh, God, this soft copy is strumming my pen with his fingers. What number is that question again? Okay, I'm almost there. Okay. What was year 2? Year 2, 60%. It's over now. So no, Abi.
Yes.
No or yes? No or
You
yes?
say no. No.
No or no yes?
Jesus,
No,
no,
yes.
I'm just joking.
No, yes.
I'm just looking for trouble.
Yeah.
All right. So in year 3, less.
Yes.
So that's a yes, Abi. Yes. All right. And in year 4, 32 is lower. So yes, Abi.
Mm-hmm.
Is that a yes? Yeah, 40, yes. Right?
Yes.
Okay, so yes. Yes.
I'm sorry. You
Yes.
have to. Can you just briefly explain? I'm going to draw you back. I'm sorry, class. Is that fine?
No, it's not fine by them.
Okay, continue.
Oh yeah, now they don't used to play with you. Talk now. Let's be going where we're going.
Yeah, babe. I'll sort it out later. I'll figure
No,
it out.
go ahead. I was playing. Go ahead.
You have to go all the way up. Your cash flows over the bond. That's all I need to know.
I didn't hear you. My cash flows, okay, all the way up. I'm all the way up now. Or you want me to go to the discursive part?
No. Just this cash flow over. I need to know why you did all this.
I should start from beginning to explain. Cash flows over the bond's life. Over
yes.
the bond life. What I was doing was to calculate. You know that they told you that first bond over the 8% bond life.
Uh-huh.
So they told you that this 8% bond. Can you hear me?
Yeah.
Okay, so they told you that this 8% bond will be an annuity, that it will be paid in equal installments over the bond's life, right?
Okay.
So wanted to find out what will be the payments over that bond's life. That's what we needed. So to be able,
it was on annuity. Sorry.
Yes. I didn't hear you.
How do you know it was an annuity?
Because just said the question said it directly. I just followed what the question said. The question said it would be an annuity. That's what.
was an equal installment.
See, they said the bond will be repaid on the basis of fixed equal annual payments constituting interest and principal. That's an annuity by definition now.
Reopening the economy. But it was interesting, wasn't it, to hear time and again the Prime Minister say this is a series of...
All right, continue.
Did you get that?
Yeah.
That's all the statement that we needed. They said the bond will be repaid on the basis of fixed equal annual payments constituting interest and principal over the next 4 years. So it means that we're going to have, all we needed to do was to do that computation, which was, we know what our, if we are able to calculate our annuity factor and divide it by the principal, we'll be able to get how much will be paid in each year. So that was that 9.05058, that value. And then that is the equal payments every year. Interest will be added to the opening, and then we get our closing. And it checked out at the end where we had technically zero because we had repaid all the whole bond in the final year, by the end of the final year.
Okay. All right.
Right. And then we, of course, use that figure more than once. This thing has gone again. And yeah, I need a hard copy of this book. I can't be doing this thing. Stressing me. All right. I should buy Abby. Buy this one. Buy it. All right. Now is this color that I don't know where it came from?
Yeah, they will.
All right. So I didn't bother copying from the question, but would have seen what the question said in terms of whether the covenant is met or not. Once we're done with that, I think we're done with this question. I don't think there's any other thing to do. It's a very simple question, fairly, at least compared to yesterday. That's all I'm doing. I'm doing my comparison now.
Yeah.
I'm surprised, but that's the end of the question now. Is that fine? Can we move on? If you've not been here today, I don't know why. You were not here the last time I checked.
But I'm here right now.
Do you get what we've done?
I've seen it. I've snapped it. I
So, Brian.
I've seen it. I've seen it. I've snapped it. Not an answer at all. All right. You said what?
Brian,
Yes, ma.
this book value, if you're asked to, if we were meant to use market value,
Yes.
what would we have done?
Then most likely they would have given us number of shares, or they would have given us one model that would have used in computing our market value. Something, some way, somehow would have computed our market value. And then the same thing for the bond. The convertible bond, particularly, would have needed to do the value for that convertible bond. So would have done, like I said, would have done that year cash flow, then the discount factor, and then the value. So would have multiplied the discount factors for the interest over the, I can't remember how many years, 4 years. And then is that the convertible bond was 7 years, Abi? I can't remember. I don't know where I got 7 from. I think it was the question I did earlier today. Well, they didn't tell us the number of years, so they didn't. That's why they didn't give you all the information. If they wanted you to do it, they would have given you information to do it. Do you get what I'm saying?
Sorry, Brian. Another question. Sorry.
Okay, I'm coming. Halima, Nabi, are you fine?
Yes, I'm fine. Thank you.
Okay, all right. Halima, please go ahead.
Your ordinary shares, why are you using 10 million? Is it because they said this senior management will contribute another 5 million?
Yeah, and I came and did it here. Like I said, there's a note to it, and I put the note beside it, just beside it. So ordinary shares will be a combination of 5 million from venture capital and 5 million from senior management.
Senior management. Okay. Okay. Thank you.
All right. Is there any other issue?
So this beginning of 5 year onwards, it was just unnecessary.
Which one?
There were different places they used from the beginning of 5 years.
Oh, no. But let's look at the third part of the question. The part C is where obviously it becomes necessary. They said, with supporting calculations, discuss whether or not the MBO will be beneficial to Dofuko and Okazuko's management team. So the way to discuss this now is we'll have to value the bond. If we we'll have to value the company, the company, and compare it with the 60 million. That's what I was expecting when we were reading the question originally. Do you get what I'm saying? If we find the value of the company and compare the value of the company with the 60 million payment, then we have answered that 8 marks. So even though they said discuss with supporting calculation, your discussion is very little. What you need to do is to compute and see whether the market value of that company. So, and that's why they gave you plenty story. They gave you expected growth rate, and then they now gave you the terminal value. They gave you information to calculate terminal value because they said in, I remember the last paragraph, it says, it is expected that the annual growth rate of dividends, so we are going to use dividend valuation model, obviously, they just told us. So the expected, the annual growth rate of dividends will reduce by 60% from year 5 onwards following the MBO. So we'll do year 1 to year 4. We already have the dividends here now. So we'll get the present value of the dividends and then do terminal value, just like we do free cash flow. This thing is very fluid. Do you get what I'm saying? Nobody answer me. It's an example of you being on your own. If my network has ceased, I won't even know. That's the problem that this thing causes. When you keep quiet like this, if I'm talking to myself for 5 minutes, I won't know.
Sorry, Brian.
This thing is really frustrating. I don't know what the person that did this thing that caused us to start hiding our face in this class. I'm sorry to say, but I don't want to call somebody. Let it not be that someone true, and the person
Don't
now.
cause you.
Well, the person suffer me.
Sorry.
Someone asked a question, so the person should have answered you right now. Somebody asks you a question and you explained yourself. The person should have answered when you said, "Do you get me?" So don't blame everybody on this.
It wasn't a question he was answering. It's number 3.
Somebody asked. He was answering a question.
You said yes?
Yeah, he was answering a question.
Okay.
So when you didn't expect me to answer you when someone else asked you something. Is the person that will be able to say, yes, I understood what you're saying?
No, but then I now went on. After I answered the person's question, I now explained what I think we should do in the part C. That's when I now asked, did you get me? And nobody said anything.
Sorry, I thought you were still talking to somebody.
Okay, because you're drifting. I'm telling you, you're drifting badly. You're just coming and going. I'm serious. As in, I cannot explain how much you're coming and going today. I can't explain it.
I expect the person to answer you that I get what you're saying. You get. So I don't know what you're talking about. So I can't answer yes now to what I don't know what you're talking about. Yeah.
All right. So what we're going to do now is to use, I don't know whether there's any other valuation model we can use. Can you see anything? Okay, so let me first answer the question. They said, so I'll say that I'm answering this part of the question, and this is one time where I'm not writing a report, so I can write under the calculation. So the covenants would.
Sorry, Mr. Brian, what you're writing.
Yes.
Yeah, why are you writing something? Why are you writing something now?
I've always written now. See me. Hey.
I'm saying, when we want you to write now, you're not right. Now I don't need you to write. You're writing plenty things. I thought you've told us what it is already.
But you made me write A, you did not say anything. Then this rubbish one statement now is the one that you're now complaining about. You see this life?
I'm just saying, because next time we need you to write, you write. I'm just saying.
I've been writing since this diet started because of you. Only because of you. I've done everything that I don't normally do because of you.
Because of me. Other people, they don't want it, right?
You're the main person that usually say I should write.
Don't write again.
All right, thank you. Hey, God, seems so wild, God.
Please write, so we need a writing.
Oh, and
Why
I
you
said
not
it's
talk
only
to
saying one that it's not on me.
Hey, God.
Yeah,
Hey, my head.
they said it's only me.
I've never felt like this before. All right, so the covenant will be met in every year over the 4-year period. Except year 2. And that's the end of my writing. Okay, see now. Okay, so I was asking, we can value the company. Can we value the company using, do you have enough information? We can value the company using asset valuation now. It's not possible. That's net asset value. But that's, okay, yes now. Okay. That's why they gave us that the market value of non-current asset is 30% higher than the book value. Do you get?
Okay, yeah.
Okay, so basically, let me give so supporting calculations, whether or not the MBO will be beneficial to Dofuco and the senior management team. So the requirement, or is that requirement? Is that what we would say now? The okay, I can call that requirement. Requirement of Bento, is that Bento's of Bento? I'll assume that it has to be their shareholders. Of 60 million, right? That's the question just set. Of $60 million for the sale of, what's this person's name? The guy I've been calling since Okwuogu. Has to be contrasted with the value of the company. So we use the asset valuation. So we're back to what we did originally with in valuation. So the asset valuation and dividend valuation model. To estimate the range for Okwuogu. So now I'm really enjoying not writing a report. So using asset valuation, the market value of company of equity. Equity and the bond. They want for the equity now of equity will be equal to the total assets minus our total liabilities. That's at least the total assets, the market value of total assets, right? But asset valuation. It's not another question I'm thinking of. All right. So that's to be today. We saw that that 1.3. I've already seen it now. So 30% higher than the book value. By using asset valuation, do we need this 30%? Yeah. And then the current assets is equivalent to the book value. So we'll do our total non-current assets. Okay. So therefore, so non-current assets. So in brackets times 30% increase. So that will be equal to, what's the total asset? 4,800, right? Times 1.3. So 4,800 times 1.3. Then current assets will be 12,300. Is Mr. Yaya back?
I'm back.
All right, sir. All right, so 12,300. You didn't tell us again today.
Well, you are no more observing the thing again. That's why.
No, but if you tell me, I will stop. I told you.
Madam, if you as usual, I refuse to remind you.
If you just tell me, I will stop. I will not. I've told you before. I look for you, but.
Madam, you are not on my side today.
I'm always on your side, but if I talk, you'll be supporting Brian's side. I try to stay on my own. And go and I take my when I want and come back when I want.
We're going back. We're going back to class. We're going back to physical class. You can't be doing this thing. It's not working again. I give up. Our total. What did they tell us about liabilities? Did they say anything will change? Did they tell us anything will change for liability?
No liabilities except the trade.
Oh yeah,
No.
but they told us something about that. It is. So how do we do that now? The bank draft is them that will pay for it, Abi. So that will have to. We will not put that one now, since it's them that will pay for it and it's them that are asking us for money. So the only liabilities we will consider are the liabilities that we will pay for, right? So what? So they say bank draft, them they will pay for bank draft. So we will not consider bank draft. They said, right? They said Bento is the one that finances the bank draft now, Abi. With the exception of the, oh, no. With the exception of the bank draft, Bento has provided all financing to Okazuko. No liabilities except the trade and other payables above will be transferred to the new company. Okay, so only the trade payables will now be our problem now. So the long-term loan will not be there. The non-current liability will not be there. So our bank overdraft, what? Let me read that thing. What did they say? Which one will be transferred?
They said the bank overdraft will be repaid by Bento Co. prior to sale of Okazuko.
So that one is not important to us.
Yeah.
Where did I see? Where did you see that? I didn't see it.
First note.
Oh yeah. Okay. So that one is not important. And then they now said, with the exception of the bank draft, Bento provides financing for all no liability except the trade and other payables. So it's only trade payables that will put, right? So
yes.
So less trade payables. So less payables. note. How much is payables?
7,900.
7,900. So this is equal to, so therefore our book value now will be equal to this minus that. So the net asset value.
Your trade payables is put 7,000.
Okay, did you say 7,900, Abi?
Yeah.
Impairment are certain. Impairment, my brain is cold. My brain is cold though. Okay, so what's that now? That's our net asset value. Okay, I said note. I wanted to write that so that we'll remember that. For another note. So I'm just putting it by the side. So note, since.
Sorry, Brian.
Yes.
Please kindly explain this number two. I don't really understand what they're saying there.
Number two, where?
Yes. Notes relating to the financial statements. Should I read it out?
Okay, please go ahead.
With the exception of the bank overdraft, Bento Co. has provided all the financing to Okwuogu Co. No liabilities except the trade and other payables specified above will be transferred to the new company when Okwuogu Co. is sold.
That's exactly why I'm doing what I'm doing. And that's the note I'm explaining. That since the only liabilities, what they are doing for us is guiding us to calculate the net asset value. So in the net asset value now, you know that you normally subtract total liabilities, but the only liabilities obtainable in terms of this scenario for the management buyout / venture capital financing for the new company, the only liability to the new company is
Which
the
new company are they talking about now?
You know that Bento wants to sell Okwuogu. So Okwuogu now, its only liability will be the trade and other payables. So we will not consider the overdraft. We will not consider the long-term liabilities.
No, but I still want to understand the new company they are referring to here.
No, technically, because ownership is going to change, and it's not like if the company will change, but its owners have changed. Once the owners of the company change completely, that's a new company now. It's like,
so the new company they're talking about is actually Okwuogu.
Yes, definitely.
Okay. All right.
So since the only liabilities to Okwuogu after the MBO would be the trade payable. Oh, I continue writing. I didn't see it. Would be the trade payables then that would be the only relevant liability. So those would be the only for the company after the sale. All right. So I hope that was. And I hope. So that figure now is essentially. So this one did not work. Oh. That's 57.44 million, right?
Yeah.
Yeah.
So that one is not working. Okay, so let's use the dividend valuation model now.
Is it because of the 60 million? The 60
yes,
million
yes,
is the
it's less than,
benchmark.
yes, that's we said that earlier. So if we read from the beginning of C, we said the requirement of Bento shareholders of 60 million for the sale of Okazu has to be contrasted with the value of Okazu. So we said that we use the asset valuation and dividend valuation models to estimate the range for Okazu. So we have done the dividend valuation, and then we want to do, we've done the asset valuation, then let's do dividend valuation, which should be a little more interesting. So dividend valuation now.
Mr. Brian.
Yes, ma'am.
Okay.
So what we are doing now is we are valuing the new company, right?
Yes, we are checking what the range of values will be for the new company so that we can have a discussion.
But Mr. Brian,
Yes, ma'am.
this question is saying whether it will be beneficial if we are selling something for 60, something worth 57 for 60 million. Is this the angle we should be looking at, or what?
Yes. So if I was using only asset valuation model, I would say based on asset valuation model, then that it will not be beneficial, and I will not recommend it. However, the asset valuation model is only, we always use the asset valuation model when asset valuation model is usually relevant when a company is being sold piecemeal, and the asset valuation model is essentially the floor. So it will not expect that the company that is being sold as a going concern will be sold as low as 57. So let's check the dividend valuation model and see whether it would be significantly higher. So let's assume that the dividend valuation model is say 80 million now, for example. Then 80 million is a lot better than 60 million. However, we also know that we usually do a lot of we usually make a lot of assumptions in carrying out our valuation model. And so if those valuations change slightly, then that slight change might significantly alter the value. So then we'll usually advise for something like sensitivity analysis or something like that. And that's the end. That's basically the comment they want you to make. However, if this value now, if the dividend valuation model is less than 60 or is just around 60, then we'll say no, they will not accept it no matter what. And then, however, we'll also still make comments on if you adjust the growth rate or you adjust the dividend small, the value might jump up significantly. So sensitivity analysis and those kind of things will still be recommended.
Okay.
Yeah, so that's the story they want us to tell.
Okay.
All right, so dividend valuation now. Best way to do this would be do for those years and then do terminal value. So do exactly like if we were working a free cash flow and we already have our dividends upstairs. So we'll have year. So 1, 2, 3, 4. And then our terminal value will still be in year 4 as usual. So dividends. And we've already calculated that before. So we'll just go and chop from the top. So where is that value? Dividend. We're not there yet. Dividend. Okay, that's dividend. But this is negative. So we'll make it positive again. So minus. Okay. It's not possible. How do that can work now? So okay. Is it dollar first or minus first? I don't know. Not sure. My Excel is not that good. Okay. Now let me see. Let's see whether my Excel has strengthened significantly or it didn't work well. Now make that absolute, which doesn't make sense. Okay, so let me do that instead. And not make that absolute. Let's see whether it will work. Where's the dividend? Sorry. Oh shit. Okay, let's see. So that's what I do. Everything is fine, it's legendary. me just walk now. And I'm so glad that these figures are correct. So 3329.92. What is it? 3329.92. And my Excel skills are improving now. So cool. All right. So that's that. So dividends now from above. So let's call it dividends from above. Please, dividends from above doesn't mean it came from God, though. Even though everything comes from God, but it's from above working. All right. The next one. What's next? We're doing a dividend valuation model. They gave us relevant cost of capital now. They knew what they were saying when they gave you that. Dividend cost of equity, Abi? I thought we saw cost of equity in the last paragraph.
Yes.
So cost of equity 12%, Abi? So discount factor at 12%. All right. So have you ever felt alone before?
When are you going to do that one?
Have you ever felt alone before, Ife?
Brian, what of the terminal value? I'm never alone.
No, I'm just asking. I know now. I trust you. Trust me that I know that you're never alone.
No, I say I'm never alone.
Yes, I'm just saying, have you ever felt? No, you've never. Even when you're with people, have you ever felt alone?
No, I've never. No, Brian, please, now what of the terminal value?
It's after this one we'll do terminal value.
Okay.
As expected now. It will be after this one. So so we have that. Is the value of this last, oh, okay, so we could have done it now. Oh, I see what you're saying. So we shouldn't have discounted yet. We should have done terminal value first, right? Okay, I get that, and I accept that absolutely. So we'll do the terminal value first before we hang this one. So I'll just copy it and allow it to go down. So all right, so let me do my terminal value. So working the terminal value now. Thank you. So that's why I was feeling alone now. So you see the stress that I would have carried on now, if not because you helped me. So work, I don't know whether this is work one though, but we'll just call it work one and go and put work one there. But we had the working up, so let's call this work two. Okay, so this was work one before. So that we just have a logical flow to this, even though it doesn't really do anything. I can still call it work one for that one. All right, so let's call that work two. It's not here. Yeah. What's our work two now? Terminal value, right? So value from year 5 to infinity. So from year 5 to infinity. So using the dividend valuation model. So our P naught now, when the hand is strong, is equal to D naught. Please tell me we have growth. Oh, they give us growth. They say it will drop by something. Abi?
We have to compute growth.
But they give us that it will drop by something, by 60% or something. Okay, we did.
Yes, it will drop.
Yes, now. Okay, let me just see what they said first. We close.
Expected that the annual growth rate of dividends will reduce by 10%.
All right. So our G now. So we said G. So I didn't hear what you said. If you please, can you say what you said again?
I said it is expected that the annual growth rate of dividends will reduce by 60% from year 5 onwards, following the MBO.
The annual growth rate of dividends. So did we have growth rate of dividends before? Did the dividends follow anything before? Oh, damn it. Do we have to calculate growth rate for dividend? Won't it follow any pattern?
No.
So we have to calculate the growth rate, the initial growth rate, Abi?
Yeah.
All right. So to get G, so we'll just use geometric growth now. Okay, we already have the dividends here, sir. So to get G, we find historic growth first of all. All these things, you'll just be throwing the thing anyhow, sha. So G now. Okay, so historic G. Our historic G will be equal to, please, I don't like the fact that I'm writing this thing, but newest, let's come back again, over oldest. It's the same thing they're asking you every day. You just ask it in different ways. Into 1 over n.
N minus 1.
Yeah, and then we can put the minus 1 later. I usually take it for granted. Okay, so close the bracket again. Minus 1. All right, so the historic G now, so that will be equal to, I will try for this question where you settle. So the oldest, the newest one, right? Oh no, I want brackets first. If not, to know. So the oldest one, the newest one, divided by the oldest one. We'll close the bracket now. Raised to the power of 1 divided by, how many is that? 3, Abi? It's n minus 1, so it's 3, right? Right?
You didn't do the n minus 1.
I did the n minus 1 now. It's 3.
Your formula, but you didn't put it there. You just wrote over n.
And so n is n minus 1 now. N is 3 years ago.
Okay, sir.
No, I'm just saying that your hand is now very strong. So now I can be doing you anyhow. It's not like before.
Hand is not strong, Brian. This is what you did last time.
But he won't find it this night. This is the beginning of a new week. You will not get me. I'm just saying do the right thing. So when someone is reading, the person will get confused. You are saying somebody's hand is strong. I will build a block on your head very soon.
Okay, no problem. Let me put. Is it because of minus 1 that I did not put inside this? That all this, all these threats to send me back to the village? Okay, oh, minus 1. Oh, quick. All right, am I forgiving for testing myself? No, I'm not saying why this thing. Why does this thing just monkey me sometimes? Oh, I didn't put the multiplied by. Sorry, devil work. So that's all that's making you to be showing yourself this week. Yeah. Oh, minus 1. What is that even cost? So this multiplied by this over this, raised to power. Now what's the raised to power? The raised to power is now with you. It's correct now. Negative growth. No, you just cry. Okay, this divided. Oh. This multiplied. Where's D naught? It's not growth I'm calculating. Where did I get this kind of formula from? Where's this figure from? Times growth, newest over oldest. Okay. Where did I get the 87 from? What's 87? Where's 87? 87. It's not like 87. I'm 87. That's 9. Okay, that's what was the problem. Alright. So did that close? Just to waste my time because of carelessness. Is that what you got? 18.75. Is that what you got?
Yeah.
Alright, so I just make that a percentage. So 19%. Wow. Okay, so what did they tell us?
Reduced by 60%.
So therefore, the future growth now so the growth to perpetuity will be equal to 60% of historic. So that's equal to 60% multiplied by.
Yeah. Yeah, go and pray. Yeah, yeah.
I prayed.
You've done it, Shai?
Yeah.
Yeah, go on.
No, voila. Okay.
Mr. Brian.
Yes, ma'am.
Reduced by 60%. Now reduced to 60%.
I have reduced by 60%. Okay.
That means it's going to be 40%.
So is that what it means? Wow.
Yes.
The
It's
head
not
has
reduced
closed.
to 60%. It is reduced
Thank you.
by.
Thank you. This thing I used to teach it when my head is. When my head, I don't know which one is it. Madam, is my head cold or hot? I want to understand.
Undetermined.
Oh God. Oh my God. Okay, so my undetermined edge is not picking the thing again. No. Let me try and see what they said. Reduced to. Where's the question? Bento. This thing has suffered me today with all this scrolling up and down. That's what's really stressing me. Maybe that's what I'm trying to preach to you. If you have a bad tool, like not arranging your work well, just that scrolling up and down, it will stress you unnecessarily. Okay, so they said it is expected that the annual growth rate of dividends will reduce by 60%. So if it's reducing by 60%, 60% of it will go. It will remain 40%, right? Is that what you're saying?
Yes, that's what she's saying.
I think I agree with that. So that will be 1 minus 60% of that. Wow. Someone said can still be picking all these things at this time. The person is a genius. So 1 minus 60% of historic. So that should be, I just do 1 minus 60%. 1 minus 60%. All right. So 7.5. Thank you. So reduced by, what would I have done without you? Right.
I don't understand what you did there.
She said it reduced by, so it's reduced to 40% of that figure. It's reducing by,
Okay.
not to. So by will be 1 minus that 60%.
Okay.
Yeah. All right, so we've calculated G. Oh. All right, what's our cost of equity? Cost of equity is what? What's our cost of equity?
12%.
12%.
12%. All right. Just tell me why this thing is 12%. Don't put anything there. Sorry to do what you want to do. All right. And what else? We have our therefore. Okay, so I'll have to write that where someone can see it. So therefore, why is this happening so regularly? I don't think this is the first time this is happening, even recently, and I don't think I corrected the last one. So therefore, our P naught, that's our terminal P naught now, will be equal to the final dividend, year 4 dividend, year 4 dividend into 1 plus G divided by KE minus G. All right. So that figure now, I'm afraid to put it there. So that figure will be equal to, so year 4 dividend, should I open the bracket or not? This, I don't need the bracket. So that into bracket 1 plus G, here's G, close bracket, divided by open bracket KE minus G, here's G again, G up. Done. I will not put times. I don't understand myself. Whether I think I'm using calculator. Figure is plenty. I hope that's what you got. But the figure is extreme.
What did you use as G in this formula now?
7.5%. Right?
So for year 1 to 4, uncle.
They are there now. It's only for the final year that we need the terminal growth rate. It's only the dividend for the final year. No, the year 1 to 4 was 19%. Is that what you're asking?
Yeah.
Was 19%.
No, I know it's 9.
Those ones that don't have any business,
Okay,
we're just looking for the final year's one. Okay, so I don't think this thing will work again. I've seen this happen before. So it's equal to that figure. It doesn't work. Okay, it is. So that's good. So we have that. So we can now have our present values now. So our present values, we don't know. If there's any question, present values will now be equal to, I'll cheat now. This multiplied by 0, that will cause problem. I'm sure if you give me 0. Oh, it's not that. Okay. I know what to do. So it's equal to sum of all of them up to value multiplied by. All right. All right. Okay. So therefore, our MPV, if you want to call it that, our value of value of equity, which will be equal to the summation so the summation of all those figures of the present values will be equal to, so sum everything. Voila. So the figure is even still less. So it's actually even less than, okay, but okay, it's higher than the net asset value. This is very, very strange. There's one very intelligent thing I would say here. If I were going to discuss this thing, I'll make the examiner excited for me. Can you just put that? Okay. Don't, okay. Is this fine, everybody?
Mr. Brian,
Yes, ma'am.
did you add the terminal value to the dividend for the 4th year
Yes, I did.
before you multiply the 0.6?
Yes, I did. You want to see the figure here? So it is the sum of 81 and 82, which is these two, times the value I did. The figure was only, see your present value. Now present value is 52,683. If I didn't add it, then the dividend is only 333.29. It's not even up to 10% of the present value. So I did add it. Do you get what I'm saying, man?
Yeah, I got you.
Okay. Okay, so I think we're done. We don't have any other issues. So it's our comment now that is remaining. So what's our comment? Can you see that? Can you see what happened? If it's still here. Halima, is this fine? So usually the person that helps me when I'm drifting.
Yes, it's fine.
Right. So our comment now. The values for both the asset valuation and dividend valuation models are less than the $60 million than the 60 million required or demanded. I don't know whether it's required. I think the word would be demanded by Bento. Therefore, based on these valuations, is it an acquisition or takeover? What do they call it? Would not
Disposal.
be, no, to them now, to the people that are acquiring. So let me call it acquisition. Will not be beneficial to either the venture capitalists, the VCs, nor to either
Okwuogu, no, the venture capital.
or the senior management? Those are the people that are acquiring now, that will have 50% of the company. Okay. However, the valuation models used are for preferable where the firm is being disposed on a breakup basis. So that's for asset valuation now. Or where the valuation is for minority shareholders. In bracket, the dividend valuation model none of which the two parties, none of which is applicable to this case, none of which is applicable. Do you get what I'm saying at all?
No.
You said?
No.
Okay, so I'm saying that when you use asset valuation model when you're disposing a firm on a breakup basis, and you use dividend valuation model is usually most appropriate for minority shareholders. Now, both of these two investors are acquiring 50% of the firm, so they are not minority shareholders, and the company is not being disposed on a breakup basis. So it means that these are valuation models are not particularly completely relevant
Suitable.
to the, or suitable, that's the right word, suitable to this case in point. So maybe in carrying out a valuation model that is more suitable to their majority interest or their significant interest that they will be acquiring might give us a value that might be higher than 60 million.
Well, but you said the valuation model used. Okay, continue. Don't worry, continue.
No, please say what you are saying, say what you are saying.
No, I can continue.
So I said the values for both asset valuation and dividend valuation models are less than 60 million demanded by Bento. Therefore, based on these valuations, the acquisition will not be beneficial to either VCs or senior management. However, the valuation models are preferable when, I could have said one, when a firm is being disposed on a breakup basis, which is the asset valuation, or where the valuation, I'm sure this will not work. So, or where the valuation is for minority shareholders. That's it for the dividend valuation, none of which is applicable to this case. So, consideration. I'm just writing now. I'll finish what I'm writing. So, consideration should, or it might be appropriate to consider other valuation models. consider other valuation models and to note that the value, particularly from the dividend valuation model, is subject to a number of assumptions, number of variables, which, if changed slightly, might significantly alter the computed value above. All right, so I could continue arguing about that they can carry out sensitivity analysis, but I think that this is a very, very adequate thing to have said. First of all, because of the mark allocation, I've oversaid things. This was 8 marks that where did that 8 marks start from? C, where's the C? Okay, I can't see the C again now. I thought I wrote C when I was starting this thing. Where was the C? Okay, C, oh, C here. All right, looking for it. My eyes is cold. All right, so I think that makes a lot of sense. Is there any question? That was 8 marks. The 8 marks was longer than the 12 marks. Oh no, the 12 marks was long. Okay, so that's that. Any comment?
Oh, Mr. Brian.
Yes, ma'am.
In the question, they didn't specify the valuation model that we should use.
Yeah, but as always, in this kind of questions, there will be the question is what is inside the question that you will use to do what you're doing, and this is where a lot of experience, a lot of know-how comes in. That's the only way. There are no two ways to it. It's just know-how now. You would have to have practiced this thing so that you'll be able to glean information quickly under exam conditions, because some of these things I'm doing, I don't think they are possible if you're seeing it for the first time. You have to be, I don't think the word is exceptional. It's not exceptional. You just have to be lucky or something for you to be able to get anywhere close to getting any good mark from this question if you're seeing it for the first time in the hall. But if you've seen it before, then you can reason with some of these things, and that's what I'm expecting, more than that you're able to just see a question and start answering it. The fact that because you've practiced them to some extent before, that you're able to handle them effectively under exam conditions. But they have already told you, as I was, like I said, at the beginning of this question, I was very confused about where I was going with this question, and many a time you think I'm lying. However, importantly is, as you start the question starts unraveling. You start seeing why, when you see something, you're wondering, why did I see this thing? There's possibilities that 1 or 2 things you might have omitted, but generally you'll be going in the right direction because you have experience of questions that are similar to this one.